This is the Retirement Solution Podcast with financial advisor Jon Hicks, founder of J. Hagan Capital.
Interest rates have come down. However, there is still some opportunity in your investments and in your portfolios. Jon is going to tell us what those items might be. Happy to have you here along with us on the Retirement Solution. If you have questions, find us anytime. Begin the conversation at retirementsolutionshow.com or click on the links we've got posted in the show notes. I mean, it seems, is paradoxical a word? Is that something I'm making up? Am I George Bush in it? No. Paradoxicaling?
Well, strategy is the way I like to focus on most of the time. No, paradoxical. No, that
paradoxical.
Works.
It seems paradoxical, the idea of high inflation rates, high interest rates. Let's get the opportunities. It does. It feels they don't correlate. However, as you have so well pointed out to us over the past few years with these higher interest rates, there's a lot of opportunity that it just hasn't been a part of the conversation up until about 2021 when everything started.
It's been a while, right? Yeah. You know, so the thing about, higher rates, the market likes it when it's cheap to borrow money.
Sure.
They really do.
Sure.
It makes a lot of sense. It's cheaper for companies to go borrow capital, cash, so they can go invest in property or plant or machines or extra operations, things like that. And it's also good for the real estate market, right? So high interest rates for a lot of people, they're not good, right? So as an investor, there's a lot of great things that you can do in a higher interest rate environment. We're going to talk about a few of them today. But one of the bigger factors I think that people need to be concerned is that what happens if the Fed, and I think you're going to talk about, what happens if the Fed can't decrease rates? That's a big one.
Let's talk about it because heading into 2025, the Federal Reserve signaled it was going to cut interest rates twice this year. Some saying only twice this year. Some saying maybe twice this year. And after the latest inflation numbers came out, still above 3% in January were the numbers that we saw. Economic advisor Jon Hicks was telling CNBC that the Fed is definitely on hold.
There was some residual hope in the markets that the Fed might get soft enough inflation data to cut interest rates again, perhaps as early as March or April. It now looks like it's not going to happen until the middle of the year at the earliest. Not only is the inflation outlook uncertain, but the economic policy outlook is uncertain. And the Fed really wants to sit back and see how things play out for a few months before it makes any more moves on the chessboard.
He said uncertain. I counted uncertain, I think at least 3 times there.
Yeah, so
go ahead.
You combine that. Think about it, Heather. Combine that with the fact that Bloomberg, Wall Street Journal, Reuters, Morningstar, they all came in with January's numbers for inflation and everything.
Okay.
And most of the jobs reports, most of the economic reports were at best, meh. I mean, that's the greatest way to say it. They weren't all that great. So here's the real concern.
Yeah.
Do I really care about what the Fed does about interest rates? Not really.
Okay.
What do I care about? My investments.
Right. Yeah.
And especially if I'm thinking about retirement or I'm in retirement, I've got a few years myself, but I want to know, hey, what can I invest in that is worthwhile while interest rates are high? And there are several things that are very attractive. Now, there's some other things that we kind of want to steer clear from.
Okay.
But there's 2 things we have to understand. If interest rates stay higher for longer, this could really impact the real estate market. And guys, this is what happens when you have a lot of credit card debt, which, by the way, credit card debt is as high today, actually slightly higher than it was in 2007. Now, remember, the whole 2008 debacle where things all fell apart really was based on way too much consumer debt. And we had a whole bunch of inflated properties that no one could buy because banks weren't allowed to lend or weren't able to lend. Now, it's not exactly the same, and I'm not suggesting that we're going to have a pop here. But let's think about it. Right now, we have pretty high interest rates. And as a matter of fact, I was looking at this statistic right before we got on. Right now, we actually have the highest number of homes for sale, newly built homes on the market that we've ever seen since 2009. 2009, the highest number of newly built homes for sale. People don't want to buy them. And actually, the existing home sales are the slowest they've been since 1995. Why? High interest rates. High interest rates. And so a lot of younger people, a lot of people thinking about relocating, or they get the choice, right? They're thinking, oh my gosh, I don't know, a 7% interest rate or 6.9 or 7.5, depending on your credit. That's really expensive. It makes my rent really expensive, or my mortgage makes my mortgage really expensive. And here's the other thing that came out in January, and this isn't good, realistically. We saw unprecedented jumps in rent car insurance, airfare, groceries, gas, and a record high increase in the cost of prescription drugs. Now, why am I saying this? Is this doom and gloom? No, it's where we are. So when you're looking at all these costs, these are factors that would cause all of the motivation and the excitement of a flourishing economy. These are things that are a little bit of some headwind. Right?
Okay.
So if the Fed can't reduce interest rates because of all this inflation, right? This is where I'm coming down to.
Okay.
If the Fed can't reduce rates, could this cause, especially with all the debt we have, could this cause a problem in the resurging economy? Yeah, kind of a big one.
Okay.
Now, what's another big issue? Guys, this is something I talk about all the time, and we're going to talk about some solutions here in a second.
Yeah.
But the other issue is that right now, for the very first time, because of the interest rate environment, the interest on the national debt is at $1 trillion a year, almost. It's $968 billion a year is the interest on our current national debt. That's a little over $36 trillion. Now, I just want you to take a quick second to think about that, right? So I know that Trump has engaged Musk and the Doge to go out there and find all these problems, right? Find all these issues and cut. But guys, no matter what Doge does, because of the amount of debt we already have as a country, we're going to pay roughly $1 trillion a year, $1 trillion in interest
just to
on the debt.
maintain the existing
just to
debt.
Be able, correct? Because what happens if we don't pay that interest? Well, that means that we've defaulted, right, on government bonds. Now, what happens? I can tell you, it happened in Mexico in the 70s. It happened to Portugal in the 60s. It happened to Greece in the 2000s. What happens is your currency basically falls apart, and you literally become a third world country nearly overnight. Literally, that has happened, and we've seen it happen in our lifetimes. We've seen it happen around the world. Everyone has generally assumed that the United States can't do that, but I'm going to make one big point here. They're not paying attention to the fact that China holds almost as much U.S. debt as anyone. The only people that own more U.S. debt than China are U.S. citizens in our pension funds, in our endowments, in our personal 401ks and IRAs and things like that. We are the only holder of more debt than China. If China decided that they didn't like Trump's negotiation tactics, they could flood the market with cheap U.S. debt. And what would that do? That would start a real problem. So the reason I'm saying all of this, we can't control, by the way, guys, any of these things.
Right.
What can we control?
That's what I'm going to say.
We can control.
Okay,
That's
tell
it.
us. Tell us what can we control? Yes.
Bingo. So again, this show really focuses on people getting ready for retirement. So if we're still working, we're in our 40s and early 50s. We just need to keep our head down, make sure we're in inexpensive, attractive, market type based investments or based on your risk level.
Okay.
Keep our head down, keep doing our job, and keep putting money away. If there is a downturn, hopefully, as it has throughout history, it'll turn back around, and that money that you're putting in buys it when it's a little bit lower before it comes back up. Now, that's what we do when we're younger.
Yep.
Now, if you're within 3 to 5 years before you retire, or you're already retired, I'm going to make sure I say this again, because everyone says, well, John, you only talk to people right before they retire. No. I'm saying you should really talk to a skilled fiduciary advisor 3 to 5 years before you retire, because it takes that long often to put a game plan together that you can stick with, that you're comfortable with, so that you know when you do retire, you can actually afford it.
Yeah.
That you can actually do it and not be forced to go back to work. Now, if you're retired, the same thing happens as right before retirement. You need to make sure you understand the 5 key elements. Number 1, how much protection do you have in your portfolio? If interest rates do go up or down, how's that going to affect what you own? Right? I think a lot of people found out the hard way in 2022. When interest rates go way up, you can lose a fortune in bonds. I mean, a fortune, almost 20+%. Some bonds that I saw actually lost 40 to 50%. So can you lose money in bonds? Yeah, unfortunately you can. And if you own bond funds, those can sometimes be the worst, because you don't even get all your money back if you hold it to maturity. Okay. So we have to understand, where is the protection in our portfolio? What kind of income are we going to need? And how do we protect it from Uncle Sam? Because again, I know that Trump keeps talking. He wants to reduce tax rates and he wants to find all this government waste. I think they're going to find a ton of government waste. I think that they're going to try to decrease taxes, but how on earth do we pay for $1 trillion of debt structure on our own debt? How do we pay that service, that debt service? We're going to have to get money from somewhere. Okay. So we could potentially do that by growing the economy more. But all the things that I cited a minute ago, guys, are the headwinds that we may be facing. So the biggest thing for all of us to understand is, if you have money that's in safe assets, make sure you're earning an appropriate rate of return. If you have a guaranteed safe asset, it's either FDIC insured or insured against loss or like a money market type account, make sure you're getting enough money for that. You should be earning somewhere between 5 to up to 9% on those safe assets. If you're not getting those types of rates of return, it could be because of some liquidity. You want more liquidity. But for the rest of us, we need to understand these may be the highest rates we're going to see for a very long time.
Yeah.
We don't know what the market's going to do.
Yeah.
But if we can lock in those high rates now, that could really pay dividends literally for a long time to come.
Okay.
So make sure that you're taking advantage and locking in, not all your money, but a portion, lock in some of these really good rates. The second thing, understand where you are susceptible to market risk, okay? Because if we do have higher interest rates for longer, that really does, especially with the debt load, not only as consumers, but also as a country we have, this could actually cause a longer, prolonged recession. Okay. So understand where your protections are. Do you have safety nets? Do you have hedges? Do you have options? Do you have derivatives? Do you have stop losses? Do you have protections? Do you have buffers? Do you have barriers to any of your accounts? All of those things I just mentioned are things that we can do. Those are things that anyone can do if they understand the asset mix to do that. Okay. Where basically you just know how much risk you're willing to accept regardless of market performance, okay? So that's a big one. Make sure you understand that. So those are the two big things. Number one, make sure you're getting a good time period on that high interest rate investment with no risk. And make sure you understand where the protections are. If you do that now, it kind of won't matter what inflation does because you will have done the best that you can do.
Okay. Also, if you have invested or included safe assets in your portfolio, make sure you're getting that rate of return that you should be getting, because perhaps you got into a safe asset before all of these interest rates and inflation numbers came into play. I mean, is that a real thing that you've seen?
Happens all the time.
Okay.
I've seen people that, locked in 5 years ago on a CD and it's just no coming due. They're earning 1.25%. Guys, if you kind of think about that, to bust out of that thing a little early to earn 5% instead of 1%, it's like half of a month's worth of interest payments in your quote unquote penalty. I typically don't like anyone paying penalties, but come on, that's simple math, right? So if you have some low interest bearing accounts or you got a ton of money in money market, think about deploying some of that and locking in the higher rates. Again, I don't know what's going to happen. The market could fall, and if the market does fall, that could be a reason that the actual Fed reduces rates. But if it doesn't, if the market just kind of does its thing and gradually moves up, inflation's probably there to stay. So lock in some of those higher rates if it makes sense for your situation.
All of this can feel a little bit overwhelming to have to figure out by yourself. You don't have to figure it out by yourself. At J. Hagan Capital, they are here to review all of your savings and investments, poke holes in your plan, show you where your opportunities might lie, opportunities you didn't even realize that you had. So let's begin this conversation. RetirementSolutionShow.com is where to do just that. Starting that conversation with Jon and his team. We also have links posted in the show notes, so you can just click there, or again, find us anytime. RetirementSolutionShow.com.
Thanks for listening to the Retirement Solution Podcast with Jon Hicks. Begin the conversation about your savings plan with Jon and the team at J. Hagan Capital by visiting RetirementSolutionRadio.com. Be sure to listen to Jon's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Incorporated is not licensed in all 50 states. To find out if J. Hagan Capital Incorporated is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital, LLC, NPN number 1882794.